In this video, I'm going to take you through this paper. My name is Savoy, and I invite you to subscribe to my YouTube channel, Captain37, and also to like my Facebook page, Marketing Study in Zambia. So in focusing on this particular paper, I want us to deal with questions that have to do with ratios. And in this particular paper, ratios was question number 4 in section B. So I am going to section B. Section B is here. And my focus is on question number 4. Question number 4 is the one that follows here. Question number 4. There's A. A reads as follows. Briefly explain the following accounting terms. And the terms that we've been given, the first one here is break-even point. Now, the break-even point is a point at which a company does not make a profit and it does not make a loss, at which a company does not make a profit, or a loss. So, for example, the quantities that a company may need to sell for it to break even is 500 units. It therefore means that if this company sells anything 500 and above by 1 unit, it is going to make a profit. If it sells anything less by 1, it is going to make a loss. The point at which the company is where it only has 500 units, and at that 500 units, it neither makes a loss nor a profit, is what is known as the break-even point. And 2 is asking students to briefly explain variable costs. Okay, these are costs or expenses incurred by a business. As a result of quantities of production. So, the more you produce, the higher your variable costs. Examples of variable costs include the amount of money that you spend on supplies. So, if you buy more supplies, the cost is going to be higher. The amount of money that you spend on those supplies is going to be higher. And that is the exact difference with fixed costs. These are costs that do not change regardless of how much a company produces. So, e.g., an example of fixed cost is rent. So, it therefore means that a business, whether you have 2 customers, you have 8 customers, you have 22 customers, it does not matter. You're still going to pay your rentals of 21,000 kwacha for the office space. That's the way it is. And then there is this one, which is number 4, payback period. So this simply refers to the time that a company is going to begin to make its profits from an investment. So a company can make an investment. For example, of 800,000 kwacha. And the payback period for this particular investment may be 8 years. This means that after 8 years, this particular business is going to be able to make its profits. And so this is how students had to answer this particular question. You need to be brief about your points, explain, but be brief. Because remember, note that it's only 2 marks, so you don't write much. Okay, let's now turn to the focus of this particular paper. And the focus of this particular paper is on B. And B is about ratios. Let me just move up like that. Ratios. Now listen carefully. Whenever you are dealing with ratios, you need to know and understand two documents. These are the income statement. This is the old name, by the way. The new name is as it is given here, statement of profit or loss. Okay, so you need to know the statement of profit or loss. You also need to know the balance sheet, which is now refers to as the statement of financial position. Let me just highlight it. Statement of financial position and the statement of profit or loss. So you need to know these particular documents for you to be able to answer a question on ratios. Any question on ratios is going to provide you with this particular information generally, okay? So ideally, examiners may ask you questions when it comes to ratios from two angles. Number one, they could ask you for the formula. Number two, they can ask you to calculate. And number three, they may ask you to categorize. Ratios. Okay, now what are ratios? Ratios are simply a financial measure that a business is going to use to assess or to evaluate its performance over a period of time, or indeed its performance against other type of businesses. And that's what ratios are. I don't know how best I can explain that. That's what they are. So I want you to consider company A. Okay, there's company A and there's company B. Maybe if I give an example, right? Company A and company B. So company A, after it has sold its goods, it takes 22 days for it to receive its payment. What is company B takes 56 days. So which of these two businesses do you think has much more money? Simple. It is this one. And therefore, sometimes when people want to invest in a business, they look at the financial statements. When they look at the financial statements, they calculate ratios to check check on the liquidity of a business. And liquidity means how easy it is for that particular business to pay off its debt. Meaning the business should have assets. It may have equipment, it may have machinery, it may have plants, and it may have land, it may have vehicles, inventory. The business must be able to convert those into money or other kind of financial resources, liquidity, to settle off its debt. I do not want this to turn into a theoretical lecture, and therefore I will turn your attention to this question again. Let me highlight it. It says, the following are summarized financial statements of Bujo Limited at 31st December 2018. So you see, what's being provided? What is being provided here is the statement of profit or loss, and also the statement of financial position. Now, if we scroll to check further, if we move down, or is it going up? Here is what is required. Calculate the following ratios. The first ratio is gross profit ratio. Then there's net profit ratio and the others that follow. So that is what I want to focus on right now to show you how to do this. Okay, so I will show you the formulas, and we will look at this particular documents that are being given to calculate, to find. As I explain, as I show you the particular type of formulas, I'm also going to explain what those ratios stand for. So let's start with this one, the one that's been given right over here, the gross profit ratio. Information on how to calculate the gross profit ratio is obtained from the income statement. And the formula for gross profit ratio is equal to gross profit divided by sales. So when we look at the particular question, the gross profit is given. And where is the gross profit given? Gross profit is given in the income statement. Okay? And where is the gross profit? Here is the gross profit. How much? 400. And what else was required? What was stated there? Sales. Sales is 100. No, this is 1,600. So let's go back. So we know that gross profit is 400 and the sales 1,600. This is multiplied by 100 because the answer is presented as a percentage. And when we do our maths here, that cancels, that cancels, okay? This is going to give us 25%. And so 25% is the gross profit, the gross profit ratio. The gross profit ratio is the relationship between the gross profit and how much money the business is making. Take note, the higher the gross profit ratio, the better. It means that a company is making a large chunk of its profits from its sales. It's possible that a company can have so much maize that they have sold, but they are not making as much money. And it is possible that a company can have not as much quantities compared, but they're going to make so much money. And so this is what is meant by gross profit ratio, the relationship between how much a business makes before it has taken out of its expenses against its sales. Let's proceed and look at B. Is it B? No, it's 2. Okay. Net profit ratio. As you may guess, there's net profit that's involved. So this is going to be equal to net profit. This is a formula. Okay. Net profit is equal to, that's not equal to, net profit over sales. And let's check. What is the net profit in this particular case? The net profit, we do know that the sales is 1,600 because we already calculated the gross profit ratio and we use the sales, which is 1,600. What we want to know now is how much for the net profit. And so I go to the statement and the income statement. That's where we find the net profit. Here it is. The net profit is 320. So let's go back so that we calculate. The net profit is 320. Divide by 1,600. Again, this is multiplied by 100 because the answer should be presented in a percentage format. And when you do your calculations, you appreciate that this is going to give you 20%. This is the answer. This is the net profit ratio. So there is a difference between your net profit and your gross profit. Your net profit, as you may already know from your understanding of the income statement, is that your net profit is obtained by subtracting your operating expenses. It could be rent, it could be insurance, it could be depreciation. You calculate, you subtract those particular expenses from your gross profit. So the net profit ratio is the relationship of the profit less the gross profit less the expenses against your sales. And that is why the formula is as indicated here. Examiners may ask you for the formula. They could simply ask you for the formula for gross profit ratio. They can ask you for the formula for net profit ratio. Now, it's easy for you to actually know this if you really look at them carefully. If it says, as you can see, for example, under 1, gross profit ratio, then you know that you're dealing with gross profit. Go ahead, get your gross profit, divide it by your sales, and multiply it by 100. If, as it is for number 2, it is net profit ratio, go ahead, go to your income statement, get your net profit, divide it by sales, and multiply it by 100, and you will get the percentage. Now, obviously, what would be required is that desired that the higher the percentage, the better. Let's move on and now look at number 3. inventory turnover period. The formula for inventory turnover period is inventory divided by cost of sales. Cost of sales multiplied by 365. The answer for this should be in days. But what does inventory turnover period mean? Let me explain. Let's assume you sell product A and you go and buy your product A in bulk. Say you buy in January, and after 3 months you run out of your stock and go and buy again. After 3 months from March, you run out of stock and go and buy again. So far, how many times have you bought? You have bought in January, you did buy in January, but we won't really count January, so we'll count March. After March, you have 3 more months, so twice. Turnover refers to how many times a business is going to reorder its products that it sells because the sales are running out, the stock is running out. So inventory turnover period refers to after how many days do you restock? After how many days do you turn over? And this is what it means. Now let's calculate. What is the inventory? Inventory. So we'll need to take note of the inventory and the cost of sales. So let's go back to our document. Inventory, we get the inventory from the statement of financial position. So let's see, where is our inventory? It's here. Inventory. So we know that our inventory is 1,000. Cost of sales is obtained from the income statement. And it's here, it's given, cost of sales, which is 1,200. Taking note of those particular values, let's go back and calculate. We know the formula, so we'll do substitution, right? Inventory, what did we say our inventory is? Inventory 1,000. Divide by 1,200. Multiplied by 365 days. When you calculate, you appreciate that this is going to give you a value of 304 days. It means that this particular business takes 304 days. Please make sure you write days because they may take away marks from you because you didn't write days. So make sure you put days because the inventory turnover period is in days. 304 days. It takes this business 304 days to turn over. This means that once they have ordered their products, for them to reorder, it will be after 304 days. This may not be very good for a business because you have 365 days, 365 days in a year. Is that correct? Yeah, 365 days in a year. And for this particular product, the turnover is in the 300s. You want a business which has got a high turnover. So it means that you will be more happier when you have less days. So for some businesses, the turnover can be 31 days. It means that this particular business is going to have more money because, you see, you've turned over. So you've turned over, meaning your products are being sold. There's a high demand for your products. And that is what any investor is going to be happy about. An investor is going to be happy at the fact that once you've ordered your products, you can turn over after 13 days, after 21 days. But if the turnover is after 304 days, there could be a problem. So that is it on inventory turnover period. I invite you to subscribe to my YouTube channel, Captain 37. My name is Savoy, but I call myself Captain 37. Please do subscribe. And the Facebook page is Marketing Study in Zambia. Let's proceed and look at number 4. What are we supposed to calculate? We're supposed to calculate the trade receivable collection period. The trade receivables collection period. Okay. So we know what trade receivable is, right? Trade receivables. trade receivables ni bankongole. People who owe us money. We've done business. Maybe we are a cleaning company. We clean their premises and they owe us money. Okay? So the formula for trade receivable collections period is going to be trade receivables divided by credit sales. Because sales can be divided into cash sales and they can be divided into credit sales. But it's trade receivables for a reason. Trade receivable in Congole, so they didn't pay us using cash. It's on credit. So that's why it's trade receivables divided by credit sales multiplied by 365. What we are basically calculating is how many days pass before we receive the money for the services that we may have provided. So we're going to go to the where do we find trade receivables? Trade receivables are an asset, and so we go and find that under the statement of financial position. And credit sales are recorded under income statement. Yes, they should be under income statement. Let's go ahead and check. Okay, let's go ahead and check. So what are we looking for? We are looking for trade receivables, and here it is. Trade receivables 800. Okay, that's trade receivables, fair. And credit sales, now sales is obviously recorded in the income statement, but what's interesting here is that sales have just been listed as sales, as you can see here. It just says sales, so we'll assume that this is the sales that's actually being referred to. And which is easy, because you see, what this name of this subject is basic finance and not financial accounting per se. So we only deal with the basics. Using those particular figures we've taken note of, which is 1,600 for the credit sales and 800 for the trade receivables, let's calculate. So we're going to substitute, right? So trade receivables, we say trade receivables is 800. Divide by credit sales, like that, right? And we multiply this by 365. Our answer is going to be, when you calculate properly, you appreciate that our answer is going to be 137 days, which is about 4 months, isn't it? So it means that after we have provided a service, Pankongole, on credit, we are going to receive our monies for that service that we provided after 137 days. What does this mean? I've already explained what it means. But the truth of the matter is that you want a business whose payment period is going to be less. So waiting for 4 days for 4 months can result in liquidity problems. So you may have other things that you need to do, but your money is held by someone else who owes you money, your debtors in this particular case. It may affect the liquidity of a business, meaning it affects how much money you have at hand to do other things. Let's proceed and look at 5. Current ratio. So the current ratio is really, you're looking at your assets and your liabilities. How much money do you have or assets do you have against how much liabilities you have? And so the formula is really easy for this one. The formula is you look at your current assets divide by current liabilities. Okay. And so we go back to our documents so that we check on the current asset and the current liabilities. Okay, let's go check on. Okay, so we have current liabilities right over here. Current liabilities, we've been told it's 2,200. Okay, that's fair enough. And current assets. What are our current assets? There's current assets here, but there is no value given for our current assets. This doesn't look. Okay, I see. So actually this is supposed to be like this, okay? So yeah, so the current assets include this and include that and include that. So the current asset value here is 12,800. Yeah, please take note. Okay, the current assets total for the current assets is this one, 12,800. So let's go and do the calculation. Okay, so current assets, what's our current assets? 12,800 divided by 2200, and this is going to give us you get your calculator. Okay, calculate also. I hope you're following through from your end with a calculator. Pause, rewind when you're not clear. I invite you to subscribe to the YouTube channel, my YouTube channel, Captain 37. I invite you to also like my Facebook page, Marketing Study in Zambia. The answer here is 5.36. That's the current ratio. Meaning, in this particular case, we have assets, and the assets, we have more assets than we have liabilities. It therefore means that we will be chizungu. It therefore means that it will be easy for the business. It's much easy for the business to convert its assets and be able to pay its debt. Let's move to number 5. Quick ratio. Okay, so there's one slight difference between the quick ratio and the current ratio. The formula generally is similar like this, okay? It's similar, but take note. It's current assets over current liabilities. But look, it's the truth of the matter is that if you are working for a company like MultiChoice and you have a stock of decoders, the decoders won't be sold overnight. Hardly sold overnight. I was there for about 8 years, and decoders would be sold probably in a week's time or stuff like that, you know. But the point is, your inventory may not always go as fast as you may want it to go, especially if that is the core purpose or the core focus of your business. So in calculating how much assets you have to be able to convert them and be able to pay up your liabilities, it may be wise sometimes not to include your inventory. And so, less inventory. And this is the formula for quick ratio, because inventory may take some while to sell sometimes. You want to sell, then COVID happens. So it means people are in their homes and people may not be able to move as much as they would have wanted to move. And your sales may be greatly dependent on people's movements. So you take away inventory. Now, it therefore means that we are going to look for our current total current assets. Okay, our total current assets were 12800. Okay, so we divide this by 2200. We're supposed to subtract inventory. So we'll go and look for inventory. Inventory is an asset. So our inventory is here. 1,000. Okay. So we go back to our calculations. Okay, 1,000 here. Okay, so what is this going to give us? This is going to give us 5.36. I think I made a mistake. Okay, this is the correct answer, but I may have made a mistake on this one. Is this the correct answer? Or what do you get? Do you get 5.82? This should be the correct answer. Okay. Wee! Lovely. I love it. With the heart. I invite you to subscribe to my YouTube channel, Captain 37, and Facebook page. Please like it. I post so much stuff. I write all the stuff that you see on the Facebook page, Marketing Study. I do it. My name is Savoy, and I'll be happy to take you through in your studies in case you want me to take you through your studies. Okay, so we are done with ratios, and you get your 20 marks. Remember, when examiners ask you questions on ratios, they may ask you for the formula. Okay, where did I write that? They may ask you for the formula, and I have shown you the formulas. They may ask you to calculate, or under a multiple choice question, they may ask you to categorize. Now, I'm not going to do that for you. Okay, generally, you need to know that there's liquidity ratios, gearing ratios, and efficiency ratios. All right, so I'm encouraging you, read about these at your own time. And I will see you in the next video.